What's happening also, most boring ass background there is. If I could open these curtains, you could see Tampa Bay. It's really awesome right now. And I know there's a hurricane on its way here. We'll see. I was here exactly 2 years ago and dealt with the hurricane, and they shut down. They shut down the hotel. I had to go from here to Miami with a friend, my buddy G, and I had to fly to Miami 2 days later because of the way that things just got tore up. So that was 2 years ago, and what do you know? It's happening again. So I should get out of here in time, and it might not even be anything. I might even hit here. So we'll find out. We'll see how it all plays out. So, interesting thing. I'm at this conference talking about, of course, economics, talking about business and all kinds of cool things. Interesting data. Individual did a presentation and he did a comparison. Because a lot of people are like, wow, you guys talk about how houses were when you were younger, and there's all this thing with kind of giving boomers shit, if you will, about the comparison of housing, and they're saying, well, your wages went up. But one of the interesting comparisons he did was, and I like to talk about it a lot, is gold versus the value of gold versus the value of the dollar. Well, he did a comparison on how many ounces of gold would it take to get a house and a median house price. So go back to 1970, right? And we'd take our interest rates all back to 1971 for a 30-year fixed. He was claiming it would be 654 ounces of gold, because the gold was $35 an ounce, to buy the median home price of $22,900. Then you go to 1980, it's 97 ounces. So that was completely different situation because gold spiked at that point. But every other time in history, you're talking about, in year 2000, it's 520 ounces. But today, you'd be 190 ounces. Actually, a lot less than that, because that's based on a $2,200 price for an ounce of gold. Now it's $2,600. So it'll be dropping down to like maybe 120, 130 ounces. That's a significant difference, right? So when you think about what it was in the 70s, 600 ounces versus 100 and some ounces. So when you start thinking about the price of gold compared to house, completely different scenario. But what does that mean? Well, we're talking about inflation, right? The cost of housing is so ridiculous compared to the price of gold, or the price of the value of the dollar compared to the price of a house. Because when you have a government that just overspends and overprints, that's where you end up. So kind of an interesting comparison. I thought you guys might find interesting. What are we looking at as far as the market right now? We got the manufacturing PMI that let's see, that went. Actually, that index went down just a little tiny bit, not much. A little bit of a drop there as far as the U.S. manufacturing global services. The FHA housing index, as well as Case-Shiller, came out with where house prices are going. They're going up. They're still continuing to go up. Even revisions from previous ones showing it's going up. So guess if you own real estate, it's only going up, guys. Doesn't matter, especially now that we have interest rates dropping a little bit, only going up. Consumer confidence, it's actually going down. So interest rate drop, but we think that we would, that this is an older reading, so we'll see what next month does. But that, everybody's expecting that drop. Maybe that might improve that. We might see that impacted. But consumer confidence getting hit like that, that's not good for the markets. It's not good for I think it probably is going to be good for interest rates, because as far as the rates are concerned, we operate off of people spending, right? Is it going to impact the inflation? If inflation starts to pull back, then it'll help us on our side. So we'll see how that plays out. But as I've always shared, I think we could be at that point where we've achieved the lowest interest rates we're going to see. Now, why do I believe that? Look at the chart. We're just looking back at that chart. So we had right here, this was the day they dropped right here. This is where we had the interest rate drop, went below our target ceiling we've shown here, and it's continued to stay below it. We can't get above it, keeps hitting it. We're going to, I believe, trade in this channel, have our interest rates going sideways, if you will. I'm going to go ahead and expand this out so you guys can see that. So I think that we are at that peak. We've seen that peak. That peak was middle of this month, September 16th. We've come off that since they dropped the federal fund rate, which only influences interest rates. We're down in this channel. We're going to play in this channel. If we do break above it, something happens, the economy moves money from stocks or any other investment vehicle into bonds again, and we do bump up, we still have this massive ceiling, which is the day they actually started quantitative easing. This is the value of the security when you had external influence. All of this from here to here was all from the Fed talking about it, proposing it, saying that we are going to do this. So we'll see how it all plays out. That's why I believe we are at that peak of interest rates. The charts show we're at that peak. We bounced off that peak. We'll see if we stay in that spot. I think we're going to be trading sideways quite a bit. So if you're waiting for rates to get better, I think your holdout is BD. You may not achieve that. If you're waiting for the election, everybody says, hey, if something, depending upon who it is, just depends upon how I buy. You're still going to buy. I think you need to be buying real estate right now because it's only going up. It's only getting more expensive, and there's a lot of great opportunities out there. So we'll keep giving you the data. It's not changing much. Data's staying about the same, but I'll keep updating you on what's out there. Thanks, guys.